Let me start the webinar. Good day, one and all. This is Dr. Sivaramana of iknowindices.com. So during that of the European session, I was giving tracking live the Forex market together part 1. Explained how exactly we should be able to track the market, identifying the intentions of the players and trade accordingly along with them. Now during part 2, I will show you the outcome of the orders what I have placed and subsequently how exactly we can handle it, whether the market is moving in line with that of our expectations, and so how exactly we are able to make use of the forecast and the market reading besides the trading strategy in order to earn money from the market. So this webinar I give once a month, twice during the day. That is why it is called twin webinar. So during the European session, I just give the forecast and also the trading ideas and take the positions before you and try to show you what happened to those positions during the US session. So first of all, I'll explain briefly how my trading system functions. Namely, we use the derived forecast, which is statistically derived algorithm, a sequential statistical analysis. And with the help of that, we are in a position to understand how exactly the players are expected to make moves in different currency pairs against US dollar, in favor of US dollar, etc. Then we try to do the market trading in individual currency pairs by noting down the initial lows and the highs around 3:30 GMT and try to find out how exactly they are making the moves in the market. Then we are able to fine-tune our trading decision. We are able to appropriately take the trading positions and see that we are in a position to earn money from the other market. But you know, there is always an element of risk associated with trading, and we minimize the risk. But in order to reduce the risk to zero, we use the trading strategy so that instead of stop, we use the hedge order to limit the risk. And once the hedge order is not filled and we are able to see profit in our buy position, then we are able to keep stop at entry and try to maximize the profit by using the stop in a profit making position as a trailing stop. And also the take profit order, we keep it away from the other market and slowly move it away as the trailing stop and the take profit orders move on either side of the current market levels. So either one will be hit so that we will be able to maximize the profit. So I will show you now what happened to the positions, what I planned or given before you during the European session. So I kept the buy limit order at 1.1138 when the market was around 1.1148, and slowly during the close of the European session, they came down and filled it. Before that, I kept the buy limit order in the case of USD yen around 101.08. That was a low set for the day at that time. And as I explained that they wanted to make further downward move around, when I was talking to you, USD yen was around 101.52 level. And it came down 50 pips from there. Subsequently, another 50 pips and filled the sell stop and came down to 100.60 to start with, and then slowly they cut the low by 1 pip to 59 and then another 1 pip to 58 and hovering around that of 100.7374 levels now. Then what happened? 100.78 I was having the hedge order and that got filled, and then market came down to 100.78 60. Then I kept stop at entry at 100.78. And then what happened? They hit the stop and placed the stop at entry was closed. Then subsequently 30 pips below, I kept the hedge order 100.48 level. So I got a buy at 101.08 and the hedge order at 100.48. And this is only in hedge order, it is not hedged because the current low is 100.58. Then once they gain the level above 100, 101, then I will remove the hedge order and keep stop at entry and continue to maximize the profit when they make an upward move. As I explained to you during that of the European session, USD was having a low 101.50 level, and they made a brief downward stop into 101.08 before that of the BOJ press conference and went up to 102.78. Then immediately many would have thought that fundamentally USD has to become, it has to gain, that means yen has to weaken, and then many would have jumped into that of the buy position, that is jumping into that of a running bus or a running train. And what happened? They went up to 102.78 and then started coming down slowly. And I was telling you that they went above that of the initial high and came down after 2 hours as an extended move on the upside, and then subsequently they are expected to make a downward move. Exactly towards close of the webinar, they came down to 100.52 to that of the initial low level and came down from there and hit the buy order. I was keeping the buy order near that of the low what they are set before making a rise. Then subsequently they come down below that, indicating that they found a lot of stops of the those who had taken 102, 101, 780, 102.50 and things like that. Those who had taken the buy position above that of the supports, the new supports, what they have found after the upward spike. So the players made the drop below that of the lows they are set and came below that of the psychological level 101 and hit all the stops and created the panic condition for the long holders. And now they are just consolidating and they are buying. So those who have got the long position before FOMC might think that USDN might make for the big drop. So they will try to liquidate the long position. But later on, the players are expected to gain the levels in the case of USDN. This is what they do time in and time out, and we need to understand. So when you come across two big events like BOJ press conference and also FOMC, they make whipsaw moves on either side. So ultimately, you find that traders follow the technicals and take position and find that the fundamental is going against. Then when they find that the fundamental is against their position, so they close their sell position and turn long, thinking that USDN will go up in a big way. The players drop it and hit their stops again. So hitting the stops is the mechanism by which they earn money from that other market. So which we need to understand. So that is possible only if we use the hedge order to limit the risk. Thereby, we'll be able to use it to limit the risk, and subsequently, when the market moves in our favor, we'll use trailing stop in a profit-making position and maximize the profit. Then in the case of USD is GBP, I kept the buy limit order at 1.2981. I was telling you that they could go up to 1.30 and come down. And at the time of talking to you during European session, they went up to 1.2995 and also made a brief upward stop and started making the slide. And 1.2981 was filled, and I kept the edge order at 1.2961 that is not being filled, and we are waiting for the USD GBP to gain the levels before that of the FOMC interest rate decision. If you look into that other market, then Australian dollar order was not filled so far. Still, it is 10 pips above. The market is 10 pips above that of the buy limit order. Let us see whether they are able to fill it. Now, after taking the position, what we do is we wait for the prime events to happen, because today you come across the FOMC interest rate decision is expected to be announced by 18 GMT, followed by that 18:30 GMT you come across the FOMC press conference. So normally what happens when the rate is not changed and it is remaining as 0.5, and later on people say that, or the expectations of the market will be what is going to be the outcome during that of the press conference. And during the press conference, by start of the press conference, even if somebody sneezes, they will make very big volatile move. This is the normal condition, and they will simply give an attribute hawkish, dovish, and things like that. And finally, they'll say nothing important happened, but still they would have made a big upward stop and a downward stop. And this is what they do most of the time. So ultimately, we need to understand that the players make the quick moves in order to trap the traders, and that we should not become victim. Now, coming to the present session, so we use the derived forecast and fine-tune it using the market reading, and use the trading strategy to limit the risk and maximize the profit. Now, what we do is we note down the initial lows and the highs around 3:30 GMT, and with the help of the live market quote page, which is displayed here, and also we use the GMT time frame in order to understand the 24 hours market. So we try to find out what is going to happen in the market with the help of the live market quote page, and see whether the players are making the specific type of moves. So the initial lows and the highs I have noted down. The forecast for today, as I explained, that they are expected to firm up and then slide during start of the US session, 13 and 13:30 GMT. They made the slide and started gaining the levels now. They are expected to make the slide further in some pairs and then create the bearish field. And later on, after that of the FOMC, or before that of the FOMC interest rate decision, they could make a firm up, and after that of the press conference, they are expected to make an upward spike in the case of Euro and GBP, and also in the case of USD. So as you come across that, they are showing negative net change in all the four majors, Euro, GBP, USDN, and USDCHF. They are showing negative net change, which is a contrarian move. They try to make it in order to handle the crosses. Then in the case of commodity pairs, USD CAD and Australian dollar, they are showing the positive net change, which is again a contrarian move, because USD CAD is showing the USD gaining move, and Australian dollar is showing USD weakening move by showing the positive net change. So they are making contrarian move, indicating that the volume is relatively very less at the current market level. So the players are simply holding the majors and making small moves on the up and down, and trying to induce the traders to commit positions in crosses. And many of the traders might think that the crosses might be unaffected because FOMC is pertaining to that of US dollar. When they try to take the position where the US dollar is not directly involved, they think that they will be able to follow technicals and earn money. But when the FOMC interest rate decision as well as the statements are out, then you find the players are expected to make the contrarian move. Again, not immediately the US dollar weakening or US dollar gaining move. So in such a situation, you come across that volatility is going to be very big in that of the crosses. So they induce the traders to commit more position in crosses, and then subsequently make the contrarian move in the crosses and trap the traders. Now you find that they are making the contrarian move in the case of yen crosses, Euro, GBP, as well as USDN, are showing negative net change. And also the European crosses, Euro, GBP as well as USD CHF are showing negative net change. So by making a downward move, they induce the traders to commit positions, and later on they are expected to make the opposite of the same contrarian move after that of the FOMC. Then you find that the traders who have taken the positions in crosses also suffer. So ultimately, whatever be the trading decision, what is more important is what sort of trading strategy we use to limit the risk and maximize the profit is vital. Now, let us compare the market to that of the initial lows and the highs. Euro, they formed the initial low around 3:30 GMT, 1.1148, and they come below that and still not breached the new low what they are set during that of the early part of the European session, indicating that they are only keeping it lower in order to give the bearish feel, but subsequently they are expected to gain the level because 13:30 the European US session starts, and if they don't breach the new low by 14 GMT, they are very unlikely to breach the new low what they are set. They will go above that of the initial low and start gaining the level. In the case of GBP, they are hovering around that of 1.2975 and still not come below that, indicating that they will again gain the level in the case of GBP and go above that of the initial high, 1.3005, and so that of the new high, stop and high 1.3012, and go at least 100 to 140 pips on the upside. Then in the case of yen, they breached the initial low 101.50 and came down to 100.58. Stopped cutting the new low 100.58 for 30 minutes from the start of the European US session, indicating that they intend to gain the levels. So they will slowly gain the level up to 101.50 and then start gaining the level because the initial high was 101.80. They start gaining the level and go up to that of 102 slowly. Then in the case of CHF, 97.86 was the initial low. They came down, still holding it and showing the contrarian move in the case of CHF crosses. And they will try to come down a little bit and then start gaining the level as well. And that will be confusing for the many of the traders because they intend to make their downward move by making negative net change in the case of Euro as well as USD CHF. And they will try to gain the level in the case of Euro. At that time, they will not drop USD CHF, instead gain slowly the level in the case of CHF. That way, they are able to bring in the contrarian move. Then USD CAD 31.76 is the initial low. They came down to 31.39 and now it is above that of the initial low. And the initial high was 1.3198 and they just breached and went up to 1.3204, indicating that they will make the contrarian move on the upside because they are holding above that of the initial high. So either way stop ins they wanted to do in the case of USD CAD. Then Australian dollar, the low was 0.7545. They breached the initial low by 10 pips during the start of the European session and started gaining the level and went above that of the initial high 75.60 and went up to 76.06. As I explained to you, they will take up the commodity pairs as a lead and then subsequently they made the slide. But in the case of Euro and GBP, they filled my buy limit order. Still, they are not filled my Australian dollar buy limit order. 75.60 was the initial high, and I kept 75.65 as the buy limit order. They are likely to make a small hit of another 5-10 pips and then start gaining the level in the case of Australian dollar also. So you find that basically the players make use of the time when the traders have got the uncertainty before that of the prime data release. The players make use of it and handle the crosses in a thin volume condition, and then subsequently they try to handle the majors in in line with that of the expectations of the traders to start with, and suddenly reverse and hit their stops. So this is what you should be able to understand. The players are not going to make all the moves in line with that of the expectations of the traders. So we understand how the market is making the move near that of the initial high, near that of the initial low, in order to find out what could be the possible move they could do it during that of the session. And also we look into that of the net change and understand what they are trying to do it at a given time. Now these are all the market timings we need to follow so that we'll be able to define when exactly they are going to make upward and the downward move. So if the forecast says that early session they will swing and then slide during that of the mid session and then gain the level during that of the late session. So we have to watch the session timings and accordingly trade so that we'll be able to really maximize the profit. See, now I had taken the position during that of the European session because of the data release, prime data release like FOMC. The market is not making any significant upward or the downward move. So as a result, we get struck. That is why many of the traders wait for the outcome and then try to commit positions. But what I suggest is we can commit positions when they are creating the uncertainty near the low what they are set, and then keep the hedge order to limit the risk. And once the position start making profit, you can keep stop at entry and remove the hedge order and maximize the profit after that of the data release. So you need not give importance to that of the FOMC statement and also to that of the interest rate decision, because the players are going to make the move either in line with that of the expected market moves, in line with that of the expectations of the traders, or against, depending upon the open positions of the traders. When all the traders have taken the buy position and wait for the market to go up, the players are here to make a downward move against the expectations, hit the stops, and later on they may rise the level. So ultimately, what is more important for us to understand which way they are going to take it after using the market trigger. Today it happens to be FOMC. That's all. So the exact outcome is not going to have any sort of significance to that of the move what they have done it. As I explained it, everybody was waiting for the BOJ press conference, and they made a big upward and the downward move. Again, they are holding and they are making the move as they have envisaged or as they have planned in order to hit the stops either way. We can give innumerable market comments. We can simply say that USDN has gone up because of press conference, and subsequently it has come down because of so and so thing, and because of this, and it has gone below the psychological level 101. All attributes we can give, but ultimately as a trader, when you are taking the position, how exactly you have to handle the position is vital. Whether the market is going to make an upward move from here or a downward move. Normally, when the market is in the middle level, it is not appropriate for us to commit a position. Once you commit the position, what happens? They go up to that of the low or make a downward stop and below that of the low, and then start gaining the level. So the ideal time to take position will be the early part of the session. The early part of the session. Now we are in the US session. The early part of the session gets over by 15 GMT. So 13:30 to 15 GMT, if you commit a position, wait for the market to react from that of the 19 to 20:30 GMT, and there you'll come across the exact opposite move what they had done initially. Then if they are making a downward stop, and then you can understand that late session they will make an upward stop and inducing the long hold, inducing the short sellers to do the short covering. So only when they create the market sentiment and act against it of the traders, they'll be able to earn money. So in order to earn their money, they continue to be cunning all the time. So we need to understand their cunningness and should not become the victim of their cunningness again and again. So for that, we need to identify the type of moves they are going to do it from time to time. And as I explained during the European session, they make the moves as less than 30 minutes, the stop and all the false move, which happens during the early or the late sessions. The false move happens during that of the gap time and also before that of the data release, so that they will pretend as if they are going to draw before the data release. Everybody holding long position might think that it might drop big and liquidate the long position. And later on, see that the market goes up in a big way after the data release, and people will say that now only the institutions have realized the outcome of the data, and then the market has moved up. That is how they will give the interpretation. So from time to time, we'll come across the interpretation might vary, but ultimately what the players do is important for us. The interpretation is nothing but an excuse, and we can accept the interpretation and say that, okay, because of such move, I have lost money. That sort of reconciliation, we can do it. But ultimately, what is more important is such interpretations are nothing but attributes. And the players later on make a differential move and hit the stops of the traders who had followed the after effect and taken the position. The typical example will be the either way stop and move. They have done it today in the case of USDN. Then you come across the move which happens more than 30 minutes up to 2 hours before the prime data release and things like that. They will not be able to make any big upward or the downward move. Now my Australian dollar order is being filled 75.65. They came down, and that will become the position. Then later on, they just hold it for about 2 hours and then reverse the market. Extended move is a quick move. So stop and false move, extended moves are all quick moves. The intentional move is the one which is the move which indicate the real intention of the players. So when they slowly gain the levels pip by pip and continue to breach the initial high and go above every 30 minutes, or breach the initial low and go below every 30 minutes and breach the new low, and that is the intentional move. And that intentions you have to follow, and invariably the intention move at the end of the move will come across 150 pips net change levels. That will indicate the end of the intentional move. Then you can take the buy position at the bottommost level. Keep the hedge order to limit the risk. You will be able to see the next day they start making the extended move, and during that time you will be able to book profit. So they make the extended move and the intentional move alternatively. In between, they do the stop ends during the early and the late sessions, false move during the gap time, and that of the before the data release time. So this we need to follow. And swings, they do it during the mid sessions when they are handling the crosses. So in the US trading platform, you do not come across the hedge order facility. In such a situation, we have to use the stop of 30 pips. And what you have to do is, when they are consolidating like this, it is not appropriate to take the position when you are trying to use the stop instead of the hedge order. What I suggest is, be an opportunity trader and wait for such quick moves on the downside. Once they stop cutting the new low for 30 minutes, you try to buy near that of the new low and keep the stop of 30 pips. So you are unlikely to be stopped out. And then you keep stop at entry as soon as the buy position makes profit, so that even if they make further downward move, you will not incur any loss. Because first of all, you have to arrest the loss making from that of the market. So once you keep stop at entry in the buy position, even if they drop, subsequently you will lose the position, but you will get a better opportunity to re-enter into the market at a lower level. So always keep in mind that we have to follow the trading strategy sincerely without any compromise. Then once the position you have taken and kept stop at entry, then you can decide upon the exit 45 pips or 75 pips or 150 pips away from that of the entry, and depending upon that quick move they are doing it as a spike or a slow gain, etc., and identify the momentum and then use the trailing stop in a profit making position, and also keep the exit order, thereby the market might hit your trailing stop or the hedge order to limit the to maximize the profit. So this you need to understand in order to keep the hedge order. In the event if the position is hedged, if the hedging facility is available in your trading platform, then you can watch the hedge for about 30 minutes, 10 to 30 minutes. 10 minutes watching is a must, and only then you will be able to understand what sort of move they are going to do it in the next 30 minutes. And then if the position is not making profit, you can close the hedge with stop at entry or with 1 or 2 pip loss. Keep another hedge order, either a tight hedge order about 10-15 pips away or an optimal hedge order 30 pips away, and then try to move the hedge order upward when the market start moving in your favor. If the hedge order is making profit, then for 30 minutes, then you understand that market is going against your expectations, and which will indicate that the traders are all holding opposite position, and thereby the players want to hit their stops predominantly before making a rise. Then what you do is you can use the trading strategy of closing the buy position and maximize the profit in your sell side, and that can be a reversal of the trade, or you can do either way trading by booking profit on the downside move after the 150 pips net change level and the new low is not being breached for 30 minutes. At the end of the late session, you can try to close the hedge with a profit and keep another hedge order to limit the risk. And once they start making the extended move, the very next day, you will be able to move the hedge order upward until you are able to keep stop at entry in the buy position and book the profit on the buy side also. That becomes either way trading. It is a simple method of there will be some buyers in the market as well as sellers in the market, and you can act as a buyer when you look into the buy position and book profit, and look like a seller and try to book profit on the sell side. Thereby, you are able to objectively trade without becoming struck with the hedge position. If you think that if you are hedged and you are struck, that means you are not able to apply your common sense. Now coming to that of the trade for the FOMC. So I have the buy position in the case of Euro. I just come to that of the edit mode so that I'll be able to enter the trade. So I have a buy position that I wish to continue, and I have a GBP buy position. USDN. Okay. So these are all the 3 positions I wish to continue holding, and you have the hedge order as well as the how exactly the positions are making profit and loss. You have it in the other slide as I showed it. Okay, here you have. So I have the buy position in Euro, buy position in USDN, and buy position in this one, GBP, and also the RC becomes a buy position. And we have seen they exactly came down and filled the buy limit order and started going up slowly. So we have the hedge order to limit the risk. And what we do is we wait for the buy positions to make profit and then subsequently move the hedge order. And once it makes about 15 to 25 pips profit, keep stop at entry and remove the hedge order. Then the hedge order purpose is over. Until such time, we keep the hedge order. Suppose again they hedged us. Then what we do is watch for about 10 to 30 minutes. The hedging is not making profit. We close the hedge and keep a tight hedge order 5-10 pips away from the other market and see what happens. Because by the time we know very well whether they are making an intentional move or an extended move. If they are making an intentional move after hedging you second time, then you can simply wait till end of the session and try to book profit in the hedge and keep once they make 150 pips net change level, and then later on you can keep the hedge order there. And if you want to improve the profit on the buy side, then you can take another buy after 150 pips drop and close both the buy position above their average in order to improve the profit. So you can do innumerable ways of trading provided you have the hedging facility. So if you've got any doubt, kindly ask me. I'll be willing to answer to those questions. Meanwhile, I wanted to explain to you that there is going to be a demo contest in FX Trade by Handtech Markets, the brokers, and you come across in this link fxtrade.com/info.info/context. Otherwise, if you see the header in FX Trade, at the end you come across the header as the context. You click that, you'll be able to get the registration form and also the rules and how exactly you can do the demo trading context. And there are prizes also for the winners, etc. But you try to make use of it and enter into the context and see how far you are able to trade successfully in a demo trading platform. You might think that if I do demo trading, it is only a paper trading, I don't make any money and my time is lost. Don't think like that. And if you are not well versed with the trading, if you are not consistently making profit in a live trading account, then it is a must for you to practice it in demo trading account and see that you do flawless trades, and then later on you can come to the live trading. So I suggest that you can make use of this opportunity and try to enter into the context. So if you've got any doubt, kindly ask me. I'll be willing to answer to those questions. Okay, here you come across the link also presented by Adinda, that fxtrade.com info/ the context. So you have to register here before 30th of September. Before 30th of September at market close by 22 GMT. Then afterwards you cannot register, you can only do the trade. And for those who have registered, they will send the instructions how to go about in trading. And they will monitor your results in our trading platform and also frequently display in FX Trade and the results of such context. Thereby you will be able to understand where you stand. So when you enter into the competition, you find where you stand as a good trader. And also this will help you to position yourself nicely. If you happen to get the prize and things like that, it's not only that you are able to earn money, you also get the recognition as a good trader, and probably you might get a job opportunity, etc., from various brokers or from that of the other institutions, etc. It is a question of only qualifying yourself in a competition. So if there is any doubt, I can answer those questions. Still, we are holding the position because of the FOMC. The market is not making any upward or the downward move, as I explained during that of the European session. So we are waiting for the moves to happen. We are taking the positions and kept the hedge order to limit the risk. And once the market moves in our favor, we will use our trading strategy to maximize the profit. So ultimately, what is more important for us is the trading strategy. Don't compromise on the trading strategy, because that is vital in order to conserve your equity. I can simply say that conserve your equity, but how do I recommend? And simply if I say conserve the equity, you will ask the question, how do I conserve the equity? So you need to use the hedge to limit the risk. And once the hedging is filled, you handle it carefully so that you can afford to lose 1 or 2 pips or close stop at entry. And then subsequently, you try to handle the position. And also, you take appropriate trading decisions if it is hedged, whether you have to reverse the trade or whether you have to just go in line with the market moves or against, etc. Depending upon the time you get in order to realize the market. Your positions, you compare it with the live market code page, you'll be able to really understand what they are trying to do it in the market, how much of profit and loss it is making, what move they are doing at a given time. When they are handling crosses, there is no need to become panic, because they will not make any big move or breach the low or the high when they are handling the crosses. That way, you'll be able to really understand and find that there is no need to be very alert when they are making sluggish moves in the market. So nearing that of the data release time, they will become active. At the time, watch, and if they are hedging you, you handle the hedge properly, and you will be able to really make a good profit. And they are expected to make upward spike after that of the FOMC. So keep in mind that the FOMC move is going to give you a great trading opportunity for you, and always keep the trailing stop in a profit making position during that particular time, because they could make the market move very volatile, because the press conference is there. For one answer, they will make an upward move, another answer, they will make a downward move. So you should be prepared for such volatile moves, because the players want to earn money. They are not interested in showing a very high level in the case of Euro or very low level in the case of GBP, etc. They wanted to really hit the stops on either side and make money. So prepare for that and try to make use of that opportunity to capture the profit, rather than being involved with it of the sentiment what they are creating in the market. So since there are no questions, I'll try to wind up the webinar. So my contact details, I have given it here. My website address, i-noindices.com. My email ID, dr@i-noindices.com. Skype chat ID, iknowiindices@hotmail.com. And also Yahoo chat, iknowiindices@yahoo.com. My phone numbers are also given here. So if you want to contact me for further clarifications or asking for any question, not that I'm trying to do a promotion, etc., because some people ask FX Street my contact details. That is why I've given it, not with any motive of trying to grab the prospective clients, etc. That is not my intention, because I know very well by word of mouth, my forecast and my trading ideas spread all over the world. And because of that, the people who can afford, they continue to take the advice from me. And still, I wanted to help the small traders who cannot afford to subscribe for such forecast, etc. But still, they want to earn small money from the market, and we should extend the helping hand for such people, because ultimately, you will have the real joy when you extend the service to others, not be selfish all the time. So I take this opportunity to thank everybody, and also FX Street. So I take this opportunity to thank FX Street for the facilities provided to present the webinar, and hope you will be able to really earn good money after that of the FOMC data release and the upward spike in the market after the statement, and see that you calmly trade and always don't compromise on the trading strategy, whatever be the forecast you follow. But trading strategy is the one which will be able to really help you in consistently make money from the other market. So focus on the trading strategy, and if you simply focus on the forecast, if 50% of the trades you earn and 50% of the trades you lose, you don't have any headway, you'll be simply wasting your time. So ultimately, the trading strategy is vital for anybody to become a successful trader, and also test your patience and also the trading capabilities in the demo context, so that you will be able to objectively understand where you stand. Wish you all happy trading, and see you on Friday when I come up for the next webinar, Asian Session Live Market Analysis. Thank you.